Hey everyone, welcome back to Corporate Decoder. Today, Ferguson Enterprises Inc. just filed a current report on Form 8K, and I'm seeing a significant event related to their debt. Quick note, this is not financial advice, just my take on public filings for educational purposes. Ferguson just announced a major debt offering, and understanding the terms is crucial for seeing how they plan to fund their future growth. So Ferguson Enterprises Incorporated, you might know them as a major distributor of plumbing supplies, building materials, and utility products, filed this report to tell us about some important financial news. They announced the completion of a large public offering of what they call senior notes. Think of these as loans they've taken out from investors, but in a big, formal way. The filing itself is dated the 11th of August 2026, and it covers events that happened around that time. This is how companies in the US tell us about really important stuff that happens outside of their regular quarterly or annual reports. Ferguson Enterprises Inc. is the company we're looking at. They are incorporated in Delaware and trade on the New York Stock Exchange under the ticker symbol FERG. You can see here they've got a commission file number and an IRS employer identification number, which are just official identifiers. Their main office is located in Newport News, Virginia. The phone number listed is 757-874-7795. They also mention they are not an emerging growth company, meaning they are a more established player and have to follow all the standard rules. Now, the core of this filing is under other events. This is where they explain the big financial news. This is the really important part. On the 14th of August 2025, Ferguson completed a massive offering of debt. They raised a total of $1.2 billion. That's $700 million in what they call 4.800% senior notes due in 2029, and another $500 million in 5.600% senior notes due in 2036. So they borrowed a lot of money. With different repayment deadlines and interest rates, the older debt pays a bit less interest than the newer debt. And here is something crucial. This debt isn't just on the hook for Ferguson Enterprises Inc., it is also fully guaranteed by an indirect subsidiary, Ferguson UK Holdings. Limited, this means if Ferguson Enterprises can't pay, this UK subsidiary is on the line to cover it. This is a common way to structure debt, especially for companies with international operations. This debt is all governed by something called an indenture. Think of it as the contract for this loan. To raise a main contract called the base indenture, which was established back in September 2024. Then, for this specific offering, they used a third supplemental indenture, dated the 14th of August, 2026. The Bank of New York Mellon is acting as the trustee, which is a neutral party overseeing the agreement on behalf of the bondholders. Now, these indentures aren't just about the money, they come with rules called covenants. These covenants are designed to protect the lenders. For example, they limit Ferguson's ability to take on more debt that is secured by their assets. They also have rules about when Ferguson or its subsidiary can merge or combine with another company. These are pretty standard for large debt offerings, and they generally aim to prevent the company from taking on excessive risk after borrowing all this money. Of course, there are also rules about what happens if things go wrong, called evidence of default. And Ferguson has the option to pay back these loans early, either all at once or in parts under specific conditions outlined in the indenture. This is called redeeming the notes. This whole offering was done using something called a shelf registration statement. This is a way for companies to get approval from the SEC to sell securities over time without having to file a new registration for each offering. It's like getting a pre-approved line of credit for selling stock or bonds. This next part talks about the underwriting agreement. This is the deal between Ferguson and the investment banks that help them sell these notes to investors. So, JP Morgan Securities and BofA Securities were the main banks handling this big loan for Ferguson. They, along with other underwriters, worked to find investors willing to buy these notes. This agreement, dated the 11th of August 2026, outlines all the terms of how the sale was managed. Like the indenture, the underwriting agreement also has its own set of promises and rules. Ferguson and its subsidiary made certain promises about their business and financial condition to the underwriters. The underwriters also have responsibilities. This is all pretty standard stuff in these types of deals. Finally, this section lists all the documents that are being filed along with this report. These are the actual legal documents that back up everything Ferguson is saying. This is the actual underwriting agreement. This is the base indenture, which they've actually filed before as part of another registration. And this is the crucial third supplemental indenture, the one that details the terms of this specific debt offering. This is what the actual 4.8% notes look like, and this is what the 5.6% notes look like. You also have legal opinions from their lawyers, Kirkland and LSLP. This is standard for confirming the legality of the securities being issued, and the consents from those lawyers to be referenced in the filing. And finally, the signatures confirming that the company officers are authorizing this filing. The report is signed by William Brundage, who is the Chief Financial Officer. This shows Hez officially confirming all this information on behalf of the company. So, what does this all mean for Ferguson Enterprises? They've just taken on $1.2 billion in new debt. This is a significant amount of money. Companies do this for a few reasons: to fund major projects, to acquire other companies, or to refinance existing debt that might have higher interest rates or nearer maturity dates. Given their size and market position, this is likely about funding growth initiatives or strategic expansion. The fact that they are issuing notes with maturities in 2029 and 2036 shows a long-term funding strategy. The interest rates of 4.8% and 5.6% are reasonably low, especially when you consider the broader economic environment. When comparing this to historical debt offerings, $1.2 billion is a substantial sum, reflecting the scale of Ferguson's operations. For example, in 2021, when Kodak issued debt, it was in the hundreds of millions, but Kodak was a much smaller company by then. Ferguson's issuance here suggests confidence in their ability to generate sufficient cash flow to service this debt over the next decade and more. What I'm watching for is how they plan to use this capital. Are they expanding their distribution network, investing in new technologies, or perhaps looking at acquisitions? The covenants in the indenture, which restrict their ability to take on more secured debt or engage in mergers without conditions, are designed to protect lenders. This means Ferguson has some flexibility, but not unlimited freedom, in how they deploy this new capital. The guarantee from their UK subsidiary also suggests that the international operations are seen as a stable source of repayment or collateral if needed. In the grand scheme of things, this is a positive signal of confidence from the market, as investors were willing to lend Ferguson such a large amount of money. However, it also means higher interest expenses on their income statement, which could impact profitability if revenue growth doesn't keep pace. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this deep dive helpful, please like this video, subscribe for more analysis, and join our Discord community linked in the description below.